I'm going to call the meeting to order. We'll start with roll call. John Vischer, member.
David Rayner, member.
Pat Keough, member.
Harvey Lewis, member.
Matt Barker, member. Gregory Williams, staff.
William Johnston, staff. Brendan Vavrika, Anco Consulting. Cynthia.
Cynthia Ramos, staff.
Thank you.
Fantastic. Okay. We have an agenda before you. I'd be very happy to accept the motion to adopt as presented.
So moved.
Do I have a second? All in favor, please say aye. Aye. Great. We have our agenda. We have the minutes from last meeting. Anyone on the board here have any adjustments, amendments, deletions that they'd like to make at this time? Not seeing any indication, I'd accept the motion to accept the minutes as presented.
I wasn't here.
Anyone? We have a motion. Do we have a second?
Second.
Get a second. All in favor, please say aye.
Aye.
All right. Our minutes have been accepted from August 26th. Silchester, our very capable investment manager, is first up on the board. So do we have Silchester here with us?
They have not joined yet. We do have Andrew Murray from Bailey
Really
Gifford.
good. Okay.
So, Andrew, are you ready to give your presentation, even though you're second on the agenda? Silchester doesn't seem to be with us at the moment.
Yes, I'm waiting for a colleague, Kevin Finland, to join. I expect he'll be on in any moment, but I could, if it's helpful, I could start, and I'm sure Kevin will be there any moment. I'll just let him know.
Would you
Go
like
on.
minutes or?
Let's since we got another minute here, let's give another minute, and then if we can keep the regular minute agenda. If not, then we can pivot.
Okay, we'll give it a few minutes, Andrew, and see if maybe even Silchester joins in the meantime.
Okay, thank you. I'll go on mute for a second, and if Kevin joins, then we will be ready.
Sounds good. Thank you. Silchester was asked to go in the beginning because they had another meeting they were trying to schedule after.
Okay, great.
They should be here soon, but
Okay.
yesterday we had a manager from California that
Kevin's in the waiting room.
asked to wait until 7 o'clock their time to give the presentation. So we put them on the agenda last so they wouldn't have to get up too early.
Oh, gotcha. Okay. That's helpful. All right.
But they've got to be used to that. Good grief.
You would think being in
Yeah,
California, if they got any East Coast clients. So would you like to let Bailey Gifford go? I mean, I hate to put Silchester off if they've got another meeting, but
Well, let's give them one more minute and then and go from there. I'm also, I don't want to pull up our business, but certainly Silchester, I'd say over the years has earned the right for a little bit more flexibility. So
Sure.
we'll try to accommodate that.
all right.
Having showed up to many a meeting a few minutes late myself, people in glass houses need to be careful how many rocks they throw.
Yeah.
Talking to the office last night, but I don't want to.
That's probably free. Okay.
Hello.
Good morning, Freya.
Yes, good morning.
Hi. We started a little bit early, but we're ready for you to start your presentation whenever you are.
Oh, okay. So you've done your rounds already and introduced yourselves and all. I missed that. Sorry.
That's all right.
Okay.
Didn't miss much.
Well, great. My colleague Jenny is here too, so she'll be typing in along the way.
Good morning, everyone.
Good morning.
I think I have 30 minutes, is that right?
That's correct, yes. Yes, as you know, we
Okay.
usually have a lot of questions, as part of our discussion, so, but feel free to take as long as you need for your presentation, but as you know, please be aware, we do probably have some follow-up questions. Let me ask you this is John Fisher. If we have questions during the course of the presentation, do you want us to try to interrupt you and have them answer? Or would you rather we wait till the end of the presentation? What's your preference?
I think to keep it dynamic, I prefer you ask while I'm on the slide that I'm reviewing, and I'll take a pause to allow for questions. I think it'll be a bit more dynamic that way.
Perfect, okay. Thank you very much.
Sure. Well, if you guys have the material, let's just start on page 4. You know, the committee at Gainesville is very familiar with Silchester. We've been presenting for many years. So the idea this morning is to review organizational changes, talk about some flows, people, and then go into the portfolio. We will just do a quick high-level review of the philosophy, but we won't spend too much time there. We'll spend the bulk of the time on the portfolio, if that suits you.
And that'd be great, thank you.
Great. So why don't we start on page 4? What you can see there is that our client base continues to be the same, primarily endowments, foundations, and pensions. We have been allowing money to flow out of the program since 2013. We set a target of anywhere between 3 to 5% of AUM. And we came up with that figure because that's about the dividends that we receive from the portfolio of our companies. So last year we were targeting an outflow of 1.6 billion, which is 4% of 40 billion. We exceeded that due to COVID. As you can imagine, a lot of clients needed liquidity. So we had our largest outflow last year. It was 7.3 billion in redemptions, partial and full. But on the other side, we had our largest inflow we've ever had since inception. We brought in 4.8 billion in contributions, again, from new clients and from existing clients. So we had a net outflow of 2.5 billion. So we exceeded our target by 900 million. As you know, many years we've had a waiting list, but with the crisis and the pandemic, really that wait list evaporated. That's why we opened up for new business in June of last year. And we remain open this year because there is no wait list, and we still need to offset some of the redemptions that go out of the program. So this year as well, we're targeting 1.6 billion of an outflow. For the first half of the year, we've had a net outflow of 800 million. So right where we should have been at the first half, but we still think redemptions are tracking at an above normal average. Our average is about 7 to 8% of AUM. They're hovering anywhere between sort of 10 to 15% of AUM right now.
And I'm curious, how do you guys prepare for those outflows within the portfolio?
Well, we've been very fortunate. Since inception, we've been able to meet all of the outflows in cash. So in any given month, we always have outflows. We have over 800 clients, 45 billion. So we do expect outflows every month. We match those outflows with inflows from contributions. We have contributions every month too. And then also use the dividends that are coming in each month to offset some of those distributions. In particularly volatile months, like a few months last year, when we really didn't have a lot of coming in and no dividends because companies were trying to conserve cash on their balance sheet, we did have to trim, names in the portfolio to meet some of our redemption requirements. But most of the time, we're able to meet it with contributions and with dividends and with some natural selling that we do every day anyway. We sell about $40 million each day in the portfolio to keep that rotation going. So there's always a book of business that we're buying and selling, which has a source of cash for us.
Great, thank you.
You're welcome. On page 5, that's everyone at Silchester in our various roles at the firm. The bulls are partners. The most significant change since our meeting is Stephen Butt's working hours. Stephen is now working 3 days a week. And our feeling, maybe we're a little biased, is that, you know, CIOs and chairmen do that already, but maybe just don't publicly announce it. We made a very public announcement about it because we wanted our clients to know that Stephen works 3 days a week now. And it's really gone very well. Silchester has been planning for transition for many, many years. The average tenure of the people on this page is 15 years. So that speaks to the longevity of individuals. And we obviously knew 26 years into the firm that we would have to address succession planning at some point. So we started planning for this 10 years ago, frankly, when one of our members was quite ill, Tom Musto, whose name might be familiar to some of you, who passed away. But Stephen stepping back from really only one aspect of his role has been planned for some time. And that aspect is the daily implementation group. Just as a quick reminder to the committee, all 10 people in that investment box write research, including Stephen and Michael and Bertrand, who are our founders. Bertrand is our director of research, so he's the most prolific. And then 8 of those 10, the names in bold, are part of PIG, the Portfolio Implementation Group, who makes the decisions on the portfolio, weighting, sizing, recommendations. Stephen remains on that group. But then we have a smaller group called DIG, the Daily Implementation Group. That is the group that Stephen is no longer a part of. Basically, what that small group is doing is executing the decisions that have been made by the larger team in the market each day and doing that $80 million of buying and selling. We're very incremental buyers and sellers. And so that little group now is just Amber, Kitty, and Michael. And it was Amber, Kitty, Michael, and Stephen. Two other points on this page worth mentioning are the alignment, which is very significant. There's a new slide since we last met worth turning to on 36, because it's one of the ways we're addressing succession. Everyone on the page 5 has an investment in the program, and that is represented with that chart on the left, internal program capital. We have $1.2 billion of our own money in the commingled funds paying the same fees you pay. So we are directly aligned with you with our own accounts. On top of that, everyone on page 5 is required annually to put 10% of our compensation into Silchester shares. We have to buy them. It's one of the ways we're creating an owner-manager culture internally. And that chart on the right shows you the growth of those owner-manager culture over the years for everyone on page 5 except Stephen and Michael, because we're not looking for them to be the majority shareholders again. Now we want Jenny, myself, members of the investment team, other people in admin, compliance, all to have ownership. And so that's what that represents on the right. The right we think of as permanent because we can't redeem those shares until we leave Silchester. The left, the program capital, is much like your liquidity. We can redeem that if we need it every month.
Thank you.
So those are really the points on page 5. Does anyone have any other questions on people or alignment or the organization?
Looking around the table right now, for us, we do not. You can continue.
Okay. Okay. Why don't we spend 5 minutes between pages 6 through 9, and Jenny will make some points there.
Okay, as Priya, said, you're very familiar with us, but just as a brief refresher, let me make a couple comments here. As you know, we are intrinsic value investors, and what we do is look to build intrinsic value by adding earnings, assets, and dividends to the portfolio. And what we do is we maximize both price and quality. We're looking for a synthesis of both. We're not distressed investors. We do want to pay low multiples, but we want quality. We want companies that have the ability to compound up their earnings, assets, and dividends over time. Page 7 is the pricing side of that equation. That chart on the left is a back test study that basically gives us confidence that we are fishing in fertile waters by choosing to look at companies in the cheapest quartile of the market. Essentially, the chart on the left is saying if you had invested in the cheapest part of the market and were able to reinvest into the cheapest quartile at the beginning of every year, you can see the increased performance that you would have captured. Our process is on the right. We screen monthly from FactSet. Companies must be in the cheapest quartile on price to book, price to earnings, dividend yield, or EV to EBIT to make it through that screen. Each member of the investment team is invited to submit proposals for research. Those proposals are submitted anonymously, and then a small subset of the investment team led by Bertrand and including 3 other members, and they're members on a rotating basis. They then look at all the submissions and set out the research priorities, essentially assigning members of the team various research assignments. So overall, we look to write about 200 research reports a year. But that's the pricing side, the screening side. The research reports get into the quality side, and that's shown on page 8. So when we're writing a research report, when we're looking at the quality of a company, essentially we're trying to understand how does a company generate free cash flow and what would threaten, protect, or augment future cash flows. Every Tuesday morning, the investment team meets and looks at 4 or 5 research reports, so essentially 4 or 5 companies, evaluates the companies on their quality criteria. The 3 major quality criteria are listed here: capitalization, free cash flow generation, and stewardship. And then everyone votes anonymously on this 1 to 5 scale as to where they think the company fits on each of the 3 criteria. Now, the research report obviously has many different categories below each of these 3 major ones, but these are the 3 major buckets. And then this chart on the left is basically a snapshot of the vote results. So there were 9 investors at this meeting, which is why the numbers in the green bars all add up to 9. And just how you would read this, for example, would be to say on the issue of capitalization, the team was pretty split as to whether this particular company was average or slightly below average, but the team thought, for example, that the company was mostly average in the case of free cash flow generation. And that's all that happens at that Tuesday equity meeting. And you see the multiples there at the bottom because it is always for us a synthesis of both price and quality. The chart on the right shows, as it says, our research productivity. We do look to write about 200 research reports a year. We do updates on the names in our portfolio every 12 to 16 months. We also have a reserve list of companies that we look at every 18 to 24 months. We do have 5 external researchers. We've had external researchers for many years, as I believe you know. We've talked about this in the past. They write research at our direction, in our format, and they are not part of the discussions or the voting. But they do help us to supplement our research output. And then kind of a snapshot of the whole process is on page 9. So as I said, we screen companies monthly from FactSet. Again, companies have to be in the cheapest quartile in price to book, price to earnings, dividend yield, or EV to EBIT to come through the screens. Investors submit proposals for research. Every Tuesday morning, the investment team gathers to assess the quality of a number of different companies. And then every 3 weeks, the portfolio implementation group, which includes all of the investment team except our 2 most recent joiners who joined about 2 years ago. They will eventually become part of this group, but they are not just yet. So it's actually 8 of the 10 members of the investment team now that then make allocation decisions on the portfolio. Allocation proposals are submitted anonymously prior to the meeting. They are discussed, and then they are voted on. And this is the same process whether it is a buy decision or a sell decision. And then it is the smaller daily implementation group, which Frias noted now is comprised of Michael, Amber, and Kitty. They work together in pairs on a rotating basis. That group would then take the decisions, the allocation decisions made by PIG, and work with our execution-only dealer to execute those decisions in the market. So it's very much a team-based approach. As you know, we don't have star fund managers. We like the anonymous voting because we think it takes as much human bias out of the decision-making as possible. And these various meetings and decisions happen no matter who is there. So if Stephen and Michael are traveling, for example, they're on vacation, these meetings and these decisions still happen. So it is very much a team-based approach.
Jenny, this is John Bishop. I've got two questions related to the previous slides. You mentioned, as an example, the average of the one company, the free cash flow was characterized as average. Is that average compared to the companies in that industry, to the overall portfolio? Could we just give a little bit more color on when you say average, what is the average you're comparing that against?
To the entire universe of availability. So this is BMW, so not just other autos, but the available companies we could have invested in any other sector or country. And
that would be the bottom, the lower quartile, or the entire sector?
Yes.
Okay, very good.
Yes, the cheapest quartile of other companies we had the opportunity to invest in.
And then the other question with regard to stewardship, could you just give a little more color about when you're evaluating stewardship? That's a broad category, and I'm specifically interested in how do you evaluate the skill of actual leadership, the human ability to lead people effectively within your stewardship evaluation?
Yeah, you're right. Stewardship in some ways is more of a subjective category, unlike capitalization, where you can look at a balance sheet and say, well, this is, well capitalized or not, and there are specific criteria for that. Stewardship for us, basically looking to see if, management's interests are aligned with those of the business. So we do look at capital allocation, the various maybe acquisitions and disposals that a company may have made, the share count, dividend payout. We look to see whether there is a credible structure and a business plan. Is this a kind of business that's overextending itself and getting into areas that maybe aren't core parts of its business? We do try to assess the scope for abuse. Does the company have poison pills? What's the voting control? What's the board composition? What are the remuneration policies? What kind of transparency is there from the board? And then in terms of operational management, we look at cost control and just management credibility, what their relevant experience is, the tenure with the company. When we are evaluating companies, a part of the research process is we do try to meet with companies and meet with managers. Now, obviously during COVID, we weren't traveling, but we were still having phone calls with managers. So we do really try to assess the competence of management, but also looking at those other pieces.
Go ahead, please.
Yeah, this is Pat. What kind of exposure does the research reports get? Is it all just for internal use?
Yes, it is. So the research reports are distributed to the team, well in advance of the meeting. So everyone's come to the meeting having read them, but yes, they are just for internal use. And our external researchers who write the reports, they are writing those reports exclusive to us, for us.
We contract with 5 ex-sell-side, buy-side analysts who are now retired to supplement our research. That's what Jenny's talking about with the external providers. We pay them in hard dollars. They provide no more than 1/3 of the output. They represent those green bars on the right.
You did find your follow-up, Pat?
Yeah.
Okay.
Okay, so if there's no more questions about the philosophy and process, we'll go into the portfolio.
We'll pick up on page 11 in the remaining sort of 9 minutes we have. What we are reflecting there is the heart of the program on page 11, the growth of earnings per share, dividends per share, and assets per share. why we put such emphasis on it is because this is what we believe is a driver of performance, market performance. We don't care about quarterly earnings estimates. It's all, kind of company speak and what the company wants you to know. We try to understand how is a company growing their book value, dividends, and earnings. And we average the three together and call it intrinsic value on the right. So what we are experiencing during COVID last year at the height of the pandemic was that in the year, earnings were down, which is that red line. They were down by 8%. That compared with EFE's earnings, which were down 24%. Last year, because the companies were posting lower earnings, many of those were looking to conserve cash by foregoing dividends or even just reducing dividends, which is why that green line dropped at 6% as well, compared to EFE's drop of 20% for its dividends per share. But book value in our portfolio remained robust. So last year, you can see that black line was flat compared to EFE's drop in intrinsic value, which was down 13%. And this year, due to the financial strength of the companies in Silchester's portfolio, the earnings have recovered. They're now up 5%. Dividends are up 13%, and book value continues to rise. So our intrinsic value for the first half of the year is up 7%. EFE's intrinsic value is up 3.5%.
Jenny, this is John Fisher again. I got another question regarding the book value, which obviously is a classic measure, especially of industrial companies. How do you evaluate the book value when you're dealing with companies like a Sanofi or some other big positions in that, there's certainly hard assets that one can look on the balance sheet, but how do you adjust the book value or evaluate a company? It's got a lot more intellectual capital rather than the traditional industrial hard assets. Could you speak to that?
Yeah, book value is simply one of 8 valuation metrics we look at. And you're right, it is less relevant for asset-light companies than it is for asset-intensive companies. We have a lot of asset-light companies in the portfolio. We have recruitment businesses, we have pharma, we have Taiwanese tech hardware assemblers. We do not make adjustments. Everything you see in our book is straight out of FactSet to show you what the actual book value of the portfolio is. So for example, why don't we use page 14 where we can actually see the book values for businesses. We don't adjust. So what you can see in the case of the buying and selling activity in the recent period, book value is the one multiple that hasn't changed on both sides of the page. While we are buying cheaper earnings, we are picking up better dividend yields with this rotation, the book value is the same. And that's because companies like GlaxoSmithKline, Novartis on that side, there is Sanofi, those pharmaceuticals are, because of accounting purposes, have higher book values, which we do not adjust. They are bought based on their look-through earnings power and their dividend yields, which you can see for Glaxo is 6%, for Novartis is 4%, for Sanofi is 4%. That is all covered by their free cash flow yield. So for us, when we think about book value, we think it has been less consistent in the last decade or so, but empirical evidence shows over a long period of time, low book value companies outperform high book value companies by a large magnitude. And it provides downside protection. But we definitely don't see it as a one size fits all. But we, are willing to pay a little bit more of book as we are with our pharmas if we see there's quality there, there's earnings support, there's dividend support. So we actually don't adjust the book values for companies we like, but to note that there are several companies that are below book value, like our financials and our other asset-light businesses.
Right.
But Silchester still puts stock in book value as a metric for valuing a business. And Jenny has some comments.
And just to also make the point too that our portfolio is cheaper than the index on price to book. And yes, Freya said certainly it's just one of the various metrics that we do look at, but we are comfortable paying that higher book value if there are if there's higher return on earnings or higher dividend yield to compensate.
Great, thank you.
The other aspect of the portfolio, other than the intrinsic value delivery, that is quite compelling is on page 12. The current valuation on the bottom right, you can see, is much cheaper than our long-term average. And that's what that X-plotted graph right above it represents. For the last several years, we have been cheaper on an absolute basis versus our own average. But today, what's even more compelling is the relative cheapness. EFI's PE is 24 times at the end of June. EFI's book value is 1.9, and EFI's dividend yield is 2.3%. We haven't seen this relative cheapness since about 2000. So that's quite compelling as well. And the correlation between intrinsic value and our performance is on 13. And it does look stronger pre-global financial crisis, but these lines are very much correlated. And you can see the rally since about November of last year, where our performance is coming up to meet our intrinsic value, but we still think there's scope for more improvement. But obviously value has been underperforming really for the last several years. But for this period from 08 onwards, we have beaten not only EFI value, but also EFI growth and EFI. And we track those figures on 25, just to show you since the global financial crisis, even though it's been particularly difficult for value, the Silchester portfolio has outperformed all of those indices. What the chart we were on shows you is that we still have scope to meet our intrinsic value growth in the portfolio, what we think the portfolio should be represented at. And so in due course, now when that's going to happen, we don't know. But one of the reasons we've been able to outperform at about 6% per annum since inception is because we consistently stick to our knitting, we stay fully invested, and continue to evolve and think about how we can fish in more fertile grounds. We haven't changed the way we look at companies, but we're constantly looking to enhance our pool of names that we look at by questioning, do we know what we're doing? Are we looking at the right metrics when we're doing our screenings every month? And that's something we discuss twice a year at investment offsites. So in the interest of time, we reviewed a little bit of the rotation on 14, but to show you on 16 and 17, and we'll end the presentation at 18. 16 shows you the country allocations, which are merely a byproduct of our bottom-up stock selection process. But clearly what you can see on 16 is shifts happen over many years, not quarter to quarter, and really not even year to year. Today, the portfolio is positioned predominantly in Asia. 41% is in Europe, which is, one of the lowest points since our inception. Japan is healthy at 34%. And even of the 14.5 in EM, most of that is developing Asia. And that's a very similar story to the sector weightings on 17, where again, we want a diversified portfolio, but we want to go where the value criteria takes us. So the shifts that have happened over years. Today, we have a healthy exposure to autos and consumer discretionary. We have financials. We have a lot of pharma, European and Japanese pharma. We have industrials exposure, but again, a diversified portfolio. And then you can see how we've ended June, your performance on page 18, where the pension plan is up 11% since inception compared to the index at 8. And obviously last year was a difficult year for us, but it was a significant comeback. We were down 24% in the first quarter, and through the second half of last year, value was sort of rewarded in a more meaningful way. And this year, it's been quite healthy.
This is John Fisher. I got another somewhat unrelated question. With regard, what's the current number of holdings in your portfolio? today, ballpark?
It's 139 at the end of June.
I'm just curious, that allocation of 139 operating businesses, is that a function of the opportunity set? Is it a function that managing a large pile of money, you need to diversify just so you don't get trapped in liquidity? But I'm curious, why 139 versus 50 or?
Yeah.
Could you spend thinking on that background?
Yeah, let's use 31 to talk about it.
Okay.
Page 31. I'll make a point and then I'll explain. You can see we had 136 companies in 1999 in that bottom box at $6.5 billion, 140 companies at $20 billion, and today 139 at $45 billion. So not a function of assets under management, the number of names. It is a function of our trading style. Silchester likes to buy and sell about $80 million a day. 50% of our intrinsic value delivery, that black line we discussed, comes from the daily rotation. In order to achieve that daily tinkering around businesses, trading up and down at 0.2, 0.3, 0.4% of position sizing is easier to do with a portfolio of 100 to 150 names than it is 50 names. We don't like the word conviction. We don't think we can pick the winners. What we think we do best is put the odds on our side with better balance sheets, companies that can generate free cash flow, and companies that are trading cheaply. And in that way, if a cluster of autos appears, we will do the research on all of them. If they all have a niche, if they're all relatively attractively valued, we'll buy all 8 or all 7 and let a few emerge and let a few fall back, rather than say Toyota's better than Honda. Today, we have Toyota, Honda, Mazda, Hyundai, BMW, and various component makers. Again, with our European pharma, we're not going to say Glaxo is better than Novartis. We'd rather buy Glaxo, Novartis, Sanofi, Roche, have some emerge naturally because of valuations and have a few fall back. And that style of trading tends to result in a larger group of names.
This is Pat again. How do you think about political risk? I mean, clearly that's changed in the last year or so. I mean, you know, some countries' values are low for good political reasons or risk reasons. I mean, do you factor that?
Yes. Yes.
Do where?
So obviously, you know, the screens just spit out companies that are trading cheaply. Now, as we know, many of them could be a value trap. They're trading cheaply for the wrong reason, or they're cheap because of something that's happening with the business, or something's not going right with their product. It is that fundamental research that is so important. So on the page that Jenny spoke to you, on page 8, under free cash flow generation, what we look at there are several questions. What are the moats in the business? How do they differentiate themselves? What are the scale benefits? One category is, what are the growth opportunities, and are they at a decent ROI? And what are the risks of change and regression? Now, in that area is where we would talk about political risk, economic risk, business risk to the business. And then when we normalize earnings, as you can see on 8, for BMW, the second line at the bottom after the historic PE is a normalized PE, we calculate what is the through the cycle earnings power of a business in a normal environment. If we feel that the environment they're operating in is going to significantly impact an area of the business, a division of the business, or earnings in general, we will adjust the earnings down and then come up with our PE for the business. We don't show you any of that work here because it has to bear itself out. But to give you what we think, the portfolio today is trading at a 15 times trailing PE multiple. You can find those figures on any FactSet or Bloomberg terminal. But we actually think on a normalized basis, our portfolio is trading closer to 11 times. So where we would make adjustments for the risks we see that could impact the earnings of a business is in the normalization we do of earnings through a cycle.
So that would change over time, say, with something like whatever risks you attribute to Taiwan.
Yes, that, because we reappraise every company in the portfolio every 12 to 18 months. So every 12 to 18 months, we are doing a fresh underwrite of the name. A whole new analysis is written by a different analyst, and then a normalization is redone. So over a 5-year period, you will have, various adjusted normalized figures, and it'll show us, do we want to remain in this business? It is one of the decisions that we use, or one of the metrics we use to make our buy and sell decisions in a place like Taiwan or Hong Kong, for example. That is a place right now that is going through a lot of risks with them trying to, retain their independence from China and all of the protests that have happened over the years. It is an area we're monitoring. You can see it's on 16. We have trimmed our exposures there from the end of 2019 to now. Most of the companies there are Hong Kong real estate businesses, but we do look at normalized earnings to assess, is this still an area or a business we want to remain in now? And we'll make a decision based on that.
Great. Thank you. Any more questions? Okay.
I just want to say one thing, which is that cash is almost zero and has always been that way since you have been aboard since our inception. We don't ever raise cash, and that's an important part of the Silchester portfolio.
Good. All right, is there anything else you'd like to add before we conclude?
Jenny?
No, I think just to stress, you've known us for many years, even last year during the volatility and pandemic, we kind of kept our heads down, and we always make tweaks along the margins, but we kept doing fundamentally what we've been doing for years, and we will continue to do that. And throughout all that, we very much appreciate your support.
We appreciate the job you've done for many years, and again, appreciate you very capably answering the numerous questions we had. So again, thank you.
And we hope to see you in person at some point.
Yes, thank you for your support.
Great. Thank you.
Thank you.
All right, does anybody take a break here before we move on to our next presentation? No? Okay. Very good. Our friends from Bailey Gifford then are up next.
Hi there, and thank you very much for having us today. I'll start by introducing myself and my colleague, Kevin Fenlon. My name is Andrew Murray, and I've been coming to this committee for a good number of years now, and it's great to see you all again. We'd like to start by saying thank you for the long-term relationship that we've developed. In 2 weeks' time, it'll be the 12-year anniversary of your investment in the Bailey Gifford International Growth Fund. So we're really grateful, and we value this partnership that we've established. So for the presentation, we're keen to structure this section in a way that suits you. If it's helpful, Kevin and I can provide an update on the firm and portfolio changes, and maybe discuss one or two of the thematic slides in the pack, if that's helpful. But please let us know how you'd like to proceed.
Well, I'd say if there's any significant institutional changes, the management-wise, we'd like to be aware of that. But if it's been relatively stable, then no need to spend a lot of time. We'd like to talk about the portfolio, your thinking in the current environment, and how you're managing the funds.
Okay, well, yeah, I'll just keep it very brief on the firm then. And I think the key point is, to your point, the firm has no major changes. Bailey Gifford is still owned by its 47 partners, and that ownership structure remains the foundation of our ability to be long-term and to put client interests first. At a more granular level, there's maybe just a couple of points I'd highlight. There is one planned change to a member of the investment team that manages the money in the International Growth Fund. So James Anderson will retire from the firm in April next year. So that's a good number of months away still. He's retiring from Bailey Gifford, not from working life, I should say, after 39 years working at the firm. Now, we're not planning to add anybody else to the team, so the portfolio construction group that looks after your money will go from 7 to 6. This is part of the annual update that we do every year, letting clients know in advance about the changes to the partnership. And there'll be 3 other partners. Those 3 others are not connected to the international growth strategy, retiring from the firm next year. On the flip side, we actually welcomed 13 new trainee investors to the firm just this September, 8 of whom will be working on the investment side and 5 on the multi-asset side. So just very briefly to reiterate the way things work on the investment floor, the vast majority of the investors at Baillie Gifford spend their entire career with the firm. So we look to start things off by seeking out intelligent, curious minds from diverse backgrounds. And of the 8 coming into the equity floor, their backgrounds range from theology, sociology, literature, economics, languages, history, and bioinformatics. So, a very diverse group of new recruits there. And the final thing on the firm is just a date for your diaries. Should you be interested and have time, I just wanted to flag that there will be a webinar on September 29th. So just over a week's time at 11 a.m. Eastern time with 3 of the portfolio managers discussing their views on the portfolio outlook and commenting on some of the updates around China. So hopefully you received that invite into your inboxes. And if you didn't, and if you'd like to join, please let me know. I'll stop there on the firm and invite questions before we get into the portfolio.
No, none. Thank you.
Thanks, Andrew. Good morning, everybody. Nice to see you all, albeit from a distance. And as friends at Silchester said, hopefully next time we can meet up in person. We live in hope on that one. In front of you on the next page that you've kindly put up, you can see the portfolio. This is as at end of June, and it's the International Growth Fund, which you're invested in. And I think the message we'd like to give you here is very similar to ones we've provided before and you'll be familiar with. And that is an optimistic message. We are pleased with the overall operating performance of the portfolio. Well, obviously, from time to time, there are pinch points in certain stocks and sectors and countries from time to time. So not everything fires on all cylinders all the time, but broadly speaking, we are happy with the portfolio and equally happy with the opportunity set and the amount of research we're doing into stocks that may in future find their way into the portfolio. We've divided it up here as per usual into time periods, blocks of 4. So on the left-hand side of the page, you can see that 20% of the portfolio has been there for over 10 years and 40% has been in the portfolio for between 5 and 10 years. So over half the portfolio has been there for more than 5 years. So we like to show that as evidence of our long-term investment thinking and long-term portfolio management. Excuse me. We've also annotated certain stocks with little pluses or minuses, and that's where there's been additions to or reductions to holdings. And on the right-hand side, you'll see NB against several stocks, and those are new buys over the last 12 months. So there's been 7 or 8 new buys into the portfolio, and you can see below that on the right-hand side, the stocks that have been sold to accommodate those new buys. And we'd be happy to talk about any of those new buys if you had any questions there. Perhaps I'll leave it there for the time being and see if you have any questions on the portfolio that Andrew and I can deal with.
None at this time.
Pardon?
No questions right now.
No questions. Okay. Andrew, do you want to take it on then?
Sure. Sure. So I guess just kind of the next 3 pages on the pack are, I suppose, thematic representations to try and bring what is obviously a very bottom-up stock-focused approach that we follow at Baillie Gifford, where we're thinking about individual companies and their individual opportunities to life. Now, I'm keen not to take up all of your time, but we're happy to talk about the portfolio insights slide that's on the screen now. there's a slide which is entitled Supporting Companies to Be Exceptional, which is about how we engage with companies to try and help them succeed, and another slide about exceptional outliers and their inevitable drawdowns. I will pick one for you if you don't choose, but do any of those slides or topics jump out as things that you'd like to learn more about?
Real quick, when you speak of digital champions, could you kind of articulate what you mean by that? If it's a
So yeah, there's a slide there with digital consumption on it as one of the bubbles. Is that what you're referring to in grey?
That's correct.
Yeah. So I suppose this is the and this has been a long held view in the portfolio. This is an allocation, and I should stress these bubbles and their sizes are outputs of our bottom-up process. That we're not targeting allocations with a top-down point of view, but nevertheless, the size of the bubbles and the themes do effectively represent convictions that we have about secular trends that we can back over the long term. So digital consumption is about the trend towards our lives being led online. In the early stages of this transition, it would have been about buying books and CDs online. That was a story decades ago. Today, the online activity that we see in the portfolio has progressed from all areas, from entertainment and buying fashion, which is an interesting one because you can buy commodity fashion through Amazon, but we think that actual high-end fashion needs its own curation, as it were, to kind of business-to-business services from kind of accounting software and sort of website hosting for other businesses. So digital consumption is this Moore's law-driven trend towards more of our lives and more consumption being online. It's obviously not a new trend, and it's one that we've been talking about for a long time. But we think it's got a very long way to go. The power of Moore's law, the sort of doubling of computing power every 2 years, means that the scope for us to activate our lives through smartphones or through edge technology with sensors in all sorts of devices, from fridges to trainers, means that more and more of our activities can be directed through digital platforms. So it's a theme of excitement, and one we can talk to you about in terms of stocks, if that's helpful.
Not that I have just one general question, but it's with regard to all these unfolding trends. Yeah, clearly we've hired you to invest in companies that I would say get their mail delivered to an address outside the United States, whether they're operating their profits exclusively outside the U.S. or not. I'm just curious, as you look for the innovation and the growth in your portfolio, but by not being able to own U.S.-based firms, did you see yourself giving up an important opportunity set? Just as a general thing, i.e., how's the innovation in the U.S. domiciled companies compared to the innovation elsewhere in your assessment?
Go on, Andrea.
I think I'm sure we both have a couple of thoughts on this. I think it's a fair point to say that a lot of the world's innovation is happening in the US, and as a firm, Baillie Gifford runs global strategies and US focused strategies, and where we run global money with a growth mindset, as the firm does. There's a large overweight allocation to the US in those global portfolios. So that's a very fair comment on observation. Nevertheless, I think at the bottom up stock picking level, where you're looking at a relatively concentrated portfolio, and in this case it's 52 stocks, there is no shortage of innovative companies to look for. We think that the scale of ambition in Europe is growing, and there's a number of companies that you could point to, from the likes of Spotify in music to Adyen in payments, to evidence that as is the opportunity set in countries like China, where and there's obviously lots going on in China right now, but no one can deny the scale of opportunity these companies have, with over 1 billion consumers to target domestically. So I won't ramble on, but I think you're right, and the broad point about US innovation is true, but at the bottom-up stock picking level, there's no shortage of opportunities for us to go for.
Great.
Yeah,
Kevin.
Yeah, no, I would support that absolutely, and I think just looking down the new buys that we made in the last 12 months sort of brings that point home. Really, I totally agree with Andrew in the sense that US has really been the home of innovation, and one area in the portfolio where I think other parts of the world are catching up now, but where initially, if you wind back the clock, say 5 years, we found it difficult to identify ideas, was in the area of health innovation, which is one of the bubbles you can see on the page in front of you. All the great healthcare stocks were in the US. I think that's changing a bit, and we've certainly found a number of stocks out with the US that are very worthwhile investing in, such as Sartorius, which is a German company that's held in your portfolio. So I think it's changing gradually, and just looking at the new buys over the last 12 months, you've got an Australian innovative buy now, pay later credit card company. You've got a Chinese healthcare stock. You've got a Swedish oat-based dairy products producer. You've got a New Zealand ERP software provider. So we are finding ideas around the world. So we're quite pleased that the opportunity set in terms of innovation has broadened out and is not proving an impediment to getting ideas into the portfolio.
Great, thank you.
We can certainly move the presentation forward, but I just want to make sure there's no more questions around that topic.
No, you can proceed. Thank you.
Okay, well, so the next two slides in the pack, I guess our ambition is always to bring you a couple of different lenses to understand both our philosophy and process in action, and also the portfolio as it stands. I'll dive into the next slide, and then we can check in on time. But this slide is called supporting companies to be exceptional. And really, the slide shows examples of our engagements and conversations with companies. But what we're trying to do is show you, by stepping back, philosophically, our belief that companies will only succeed. And when I say succeed, I mean, in our terms, at least double in value, if not more. They'll only succeed over the long term if they are well run. And by that, we mean they're thinking about many years ahead rather than the next quarter. If they treat their stakeholders fairly, and if they're ambitious. And we think we've got an important role to play in making sure that those things happen. Baillie Gifford's a big firm now, and international growth is a big strategy. We can have a meaningful say at the table with some of these companies. So how do we do that? Well, we do actively engage these companies to encourage them to do the right things. We're definitely not an activist investor, but where it's appropriate, we can be active. And second, as a firm, we have a common set of stewardship principles, which you can see in that sort of boxed off area in the top right there. And this common set of principles ensures that all of the portfolio managers across all of the different strategies at Baillie Gifford are singing from the same hymn sheet. There's a lot of holdings that are held by different strategies at Baillie Gifford that are common across those strategies. So we need to make sure that our engagements are consistent. Now, international growth is not an explicit ESG strategy, but good stewardship is very important. And every year we set out our activities in this space in a stewardship report to explain how and what we've been doing. And we don't pretend that we've got advice to give to all companies. Far from it. But what we're showing here is a selection, I guess, some very short vignettes of some conversations, and they're a point in time piece in ongoing conversations we're having with all of the companies in the portfolio over time. So, just to pick out a few examples, you could sort of lasso 4 of those companies together and as a theme, and talk about helping companies to scale. And that's one of the things that I guess international companies have done less well in many occasions than US companies, especially in the kind of tech and the new industries. But you've got companies like Xero at the bottom right there, which is a New Zealand-based accounting software company, and Temenos, which is in the sort of bottom row in the middle there, which is a Swiss banking software company. So they're both software companies in the finance sector, and they're both growing very fast, and they're going through growing pains. So in Xero's case, the founder is stepping back from the business. We've been talking to them carefully about how to develop their board and strengthen their board so that the firm can continue to grow in the absence of its founder, which, as you know, we think founder leaders are very important. In Temenos's case, they build the back-end software for banks around the world that have decided that they want to outsource some of that software development. We think that Temenos has to get more high-level expertise onto its board and recruit from Silicon Valley. And that can be difficult for European companies because the pay structures are different in Europe than they are in the West Coast of America. So we've had to encourage them to be ambitious and bold in making those appointments. You can say the same thing about GenMab, which is going from a small biotech to a very large biotech very quickly. And how do they retain their science-based culture as they scale? And indeed, with the same with Zalando in fashion and how it kind of grows and stays ambitious, even though it becomes a very big company. In some cases, that encouragement we've been giving has resulted in companies raising more money. So we've been actively supporting companies to think about raising money in capital markets. So Argenx and Global Fashion Group are two companies there where we've supported them on multiple rounds of capital raising, and we've actually been the kind of cornerstone shareholder that's backed up their step forward to the markets to raise new capital. And in those cases, we want these companies to keep investing in R&D and infrastructure and marketing to grow their businesses. We need companies to be taking on risk so that we can have the outliers that we're looking for as the companies that will drive your returns. So I'll stop there, to avoid the risk of boring you too much, but to invite questions on that topic if it's helpful.
I have one. This is Matt. I noticed you had some mention here about Rolls-Royce, and I also saw that you removed them from your portfolio, which was a long holding for you, well over 10 years, I guess. Can you talk to maybe why you did that? Was it something they didn't do that you suggested, or what transpired there?
Yeah, I'll have a quick stab, and Kevin might add some more color. Rolls-Royce was a long-standing holding. It was the original thesis was based around the fact that it was essentially a duopoly market, where Rolls had a gaining market share with its jet engine designs. And we saw a long-term secular increase in demand for long-haul air travel with rising, sort of affluence, and especially in Asia. It hasn't worked out. There's been lots of engine technical sort of problems and challenges. So the investment case was struggling in any case due to a number of issues at Rolls-Royce, not all within their jet aero engine division. And then the impact of COVID and the impact of that on foreseen demand for jet engines and travel globally really kind of pulled the rug from the investment case. We are long-standing, sort of long-term shareholders, and we want to be patient with companies. And we actually supported a relatively new CEO, Warren East, who we knew from another company, a previous holding in the portfolio. We thought he was doing the right things to manage the business and turn it around. There was a capital raise late last year, around this time last year, it was being discussed, and we decided at that point to support them because the market sentiment towards Rolls-Royce was very poor at the time, and we thought that the capital raise went well, and Warren was proposing some sensible measures. The share price would rebound, and it did, and we benefited from that, albeit that was a small catch-up after making poor returns for you over a period of time. So we eventually pulled the plug on that investment. And Kevin, do you want to add any more kind of colour to that?
No, I think that's right. I think the capital raise at the end of the year, we knew it was a pretty binary event in that they needed the money, and we did suspect that if we and other shareholders supported it, the price would bounce substantially and give us the exit opportunity, and that's what happened. Yeah.
But I think that the reason why the Rolls-Royce was on the supporting companies to be exceptional, the story there was that a combined narrative with recognizing the layoffs that Rolls-Royce were making at the time, and the strain that was being put on the workforce, the need for Rolls to retain the support of its work base. And we're very familiar with the towns and cities in the UK that support that company. The company had to demonstrate some self-restraint in terms of its own management remuneration packages at that time. So we were having active conversations with Rolls-Royce during last year around that aspect, treating all stakeholders fairly. in the way that business was being managed.
John, you may be addressing it later in your presentation, so I don't need to jump ahead, but certainly the goings on in China politically, I mean, some of the challenges there with peers, without, a real strong rule of law and so forth. We'd love to understand sort of your current view. Obviously, it's been painful in China this year, but is this a transitory issue? Clearly, there is great opportunity with the size of the population and future demand, but boy, it looks like a kind of a mess at the moment. So we'd love to hear your perspective on that. And I think that would be a key discussion point for the committee, if you can intertwine that into your remaining presentation.
Yeah, well, let's try and deal with that now. Gosh, there's many moving parts to this, as you're hinting at in your question. I think the context is that, and just for the sake of for the record, as at the end of June, when which is the data we're talking to, China was 19% of your portfolio against 12% of the benchmark, and you were invested in, and still are, in fact, invested in 7 Chinese stocks out of about 53 in the portfolio. So to put in our context is that regulation remains a fact of life in China. It is a fact of life in China, and we have to balance that risk against potential rewards of investing in great companies. And you can see on the slide right in front of you, these are 10-year returns for the International Growth Fund, stocks in the International Growth Fund. You can see 2 Chinese stocks have been fantastic performance for the portfolio. One of them is Tencent, which has been in the portfolio, I think, the entire time. And the other one is NIO, which is about 6 down. It's the electric vehicle manufacturer, which is a much newer holding, but has been in the portfolio about 3 years, I think. So if we're taking the view that we don't want to invest in China because there's political risk, there's regulatory risk, that would have cost your portfolio returns. There's an opportunity cost if we're taking that view. So regulation is a fact of life, and indeed we have been here before, in the sense that Baidu, which was a sale within the last 12 months, actually this is a Chinese search engine, was subject to some regulatory actions in 2016, and Tencent, the stock I just mentioned, was subject to some gaming regulations back in 2018, and indeed is undergoing some further gaming regulations right now, which limits its ability, limits the ability of younger people to play games online. So regulation is there, but I mean, it's definitely true to say that the temperature has risen. So what are we doing about that? Well, the first thing we're doing is, in portfolio trading terms, is not a lot. You know that our style is not to make knee-jerk reactions to events. And this is a classic case where we are not going to take or make any knee-jerk reactions. So we're trying to stand back and take a long, cool look at what's going on. And we're going to do that on a stock-by-stock basis. So what we're doing right now is working through each of the stocks in your portfolio and trying to assess where they sit and where the opportunity set will develop for them in relation to what looks very much like, a harder regulatory regime going forward. So it's definitely on a stock-by-stock basis, although in broad terms, I think it's fair to say that on what we know right now and on the way it looks right now, it could, I stress could, it could be that the extreme growth opportunity that drives the sorts of returns you're looking at on the page there, it could be that those are crimped going forward. So that leads us to question, not necessarily whether these stocks are worth their place in the portfolio, but how we size those stocks in the portfolio. So those are the sorts of questions we're dealing with at the moment. So we're going through it stock by stock. We're thinking about sizing. And we're also wondering if the very large stocks are going to be, crimped in terms of what they can do and what types of businesses they can invest in. Tencent being one of those very large stocks. Does that in fact create opportunities for some of the younger smaller companies in China to come through in a way that they wouldn't have been able to beforehand. And that's another dynamic. So long term, China remains very interesting to us. You know, the opportunity set is massive. There's going to be growth. There's lots of good companies there. We've got our office in Shanghai. It's been up and running for 2 years now, our research office, which is unearthing lots of interesting opportunities. So, you know, China's far from dead as an investment opportunity. It's just how we deal with it in terms of this regulatory dynamic. As I said at the start, there's lots of moving parts, and you know, there's lots of pieces to the answer. But you know, so more of this or none, I think.
How do you, again, I'm curious in terms of getting accurate an understanding of the company's operations and so forth. I mean, in terms of the transparency, willingness of Chinese management to be straight with you. I mean, how do you gather information that you're comfortable with in terms of how you're building your business thesis?
Yeah, we actually think that we've been investors in the companies for a long time, and actually we found management access to be very good over many years. So access to the top people at Tencent, at Baidu, at Alibaba, at Neo in your portfolio, at all sorts of companies. So access has not been an issue actually, and I think it's been enhanced with our Shanghai office because you've now got native Mandarin speakers in the office. And also, excuse me, natives of China who understand, particularly for the way younger people, consume media and shop and things like that. They understand the sort of fast-moving world far better than I do, for example, that people in China are living in. So I think it's been the Shanghai office has been a great thing, and getting to meet companies and getting to see management has not been an issue actually.
Good to hear. Thank you. Please go ahead, continue.
Well, there's one more slide thematically, but I only want to go into it if it's of interest in your time. It's talking about our approach to being long term, and there's some data on performance, but it's not our intent to present at you. It's really only if it would be helpful to go through that the slide that was on just a minute ago. Please let us know if that would be helpful. It's not essential for the portfolio. It's more around our process and how we approach things.
I think a brief summary of that would be helpful for the committee.
Okay, sure. I'll keep it short, but I do think it does talk to the philosophy. So it's the slide before that. It's not the performance slide. It's the one, this one here. So some of you will have seen the core chart here before. We call it our asymmetric returns chart, and it's showing you how we seek to generate returns. We want to own growth companies with a potential to at least double in value, if not more. And we want to capture that upside potential by being patient and allowing time for compounding. So the bar chart shows you our best 10 returning stocks in the fund over the last 10 years and our worst 10 over the last 10 years. And you can see that the most successful holdings have all increased by more than threefold, and a couple of them there by more than tenfold. And we're showing you the worst 10 holdings as well, and for a reason. First, we're showing the worst 10 holdings in the last 10 years. First, because our process requires us to be ambitious and take some risk at the stock level. Remember, we have portfolio diversification here, and what we're doing is a process that we would expect to make some mistakes over time. And the second reason for showing the downside is that the maximum downside is 1 times your money, and that is, I hesitate to say small, but that is paled by comparison when you look at the upside, which can be unlimited. So our ambitious long-term approach is really focused on trying to exploit the asymmetry between the downside and the upside. And we're trying to benefit from the upside potential by being optimistic and having an optimistic blue sky mindset and being patient. And the key point of this slide is how hard it is to be patient over time. One, because firstly, because the most successful stocks out there, the best stocks, the ones you really want to own, are the most volatile stocks out there. And you can see this in the share price charts on the right-hand side. Those green lines are, well, it was the top 3 stocks in our in our asymmetric chart. It's now 3 out of the top 4. So Mercado Libre, Tencent, and Meituan are 3 of the top 4 returning stocks in the last 10 years. And each of the yellow circles or the orange circles are a drawdown event where the stock's fallen 30% or more from its peak to trough. And so Mercado Libre's got 6 of them, Tencent 2, albeit I think there'll be a new one if we extend the data to today. And M3 has got 4 of them. So these best stocks we've got in the portfolio have each had multiple drawdown events. And it's hard to overemphasize how difficult that is for portfolio managers as an experience. When the stock that you're sponsoring is going through one of these really tough times. But being patient is something that Baillie Gifford is really good at. We've got a culture and structure and a heritage of being good, patient investors, always checking in on the fundamentals, but not feeling compelled to act in a short-term way. Another point I'd like to sort of leverage off this slide would be something we talked about in the past, and how Baillie Gifford is working with academia increasingly around the world. We've got lots of networks with universities, and one of the important connections we've made is with a professor called Hank Bessenbinder. He works at Arizona State University. We've talked in the past about how he's underlined our belief in the power of outliers as what drives stock market returns and indeed portfolio returns. And we did some further work with him. We had him do a number of additional studies to try and understand more about this dynamic of outlier stocks. And one of the things we asked him to look at was volatility in the most successful stocks. And he looked at, in the US, I should say, but that's where the data was the easiest to access. But he looked at all US publicly listed stocks over the last 70 years. That's obviously a huge data set. And his findings really emphasize that, and if you scroll down a little bit more, a quote from his research that even those investments that are the most successful at long horizons typically involve painful losses over short horizons. And it's really that experience that we're trying to conquer at Baillie Gifford and being patient. And just a couple of examples from his research. Apple has created more wealth than any other company in 39 years in the US. But it's had drawdowns of over 70% on 3 occasions. And Amazon is the 4th largest wealth creator in the last 22 years. But in 2000, it experienced a 91% drawdown. So, we think we've got an edge in riding out volatility and being patient where we see upside. And I just wanted to use this slide to kind of talk about this important facet of what we're trying to do. And so when we see turmoil in China, it's important that we look at the company fundamentals and take our time to really assess where the opportunity lies. And there will have been changes in China, but we need to be patient where it's appropriate to be so. And then you can really start to benefit from the upside that these great stocks offer. It wasn't quite as brief as I was hoping for, but really keen to see if you've got any questions on that topic.
Will you be speaking more to this topic at the workshop you emailed us? I think it's on this September.
Yeah, I think that this specific topic probably is more about the philosophy, like really the deeper philosophy. I think the conversation in September will be more about forward-looking areas of excitement around where we think the portfolio research direction will be going, and what we think will be the opportunity set over the next 10 years. And also there will be a focus on China. We will present a few thoughts on China, and I'm sure there'll be some questions on that topic. So I'd say those are the 2 things that will come up on that webinar.
Great, thank you. Any additional questions from the board? Well, gentlemen, as always, it's always a thorough discussion with you, and we appreciate you allowing us to interject and ask a lot of questions. So it's always very helpful for the board. So again, thank you.
Thank you very much.
Thank you very much for your time.
Okay, great.
Bye-bye.
Thank you. Bye-bye.
Bye.
Next on our agenda is Anco. Brendan.
Good morning, everybody. With Baillie Gifford just finishing the presentation, I just thought I'd give you a little bit of context, because I've heard a few other either emerging market or other international managers kind of talk about the China thing. It was sort of a similar type themed answer. In short, kind of paraphrasing, yes, it's painful anytime you have one of these events, because it kind of comes out of nowhere. And if you own a Tencent or some other company that might be impacted, it's painful. But the sense that I'm getting from not only Baillie Gifford, but some of these other managers is they kind of almost see a greater opportunity moving forward, because again, it was so top heavy dominant there. that if some of that is removed, it kind of opens up the rest of the universe. Now, again, it'll take some time to navigate all of that, but the kind of viewing it really as an opportunity as much a less a fear-based thing where you say, well, gosh, I don't know if we should be in China anymore because we might be in a company that gets hit the next time something like this happens. So again, just kind of wanted to provide a little bit of relative context. I heard that a little bit in what they were presenting, but just thought I'd echo that from
So
some other
it
managers.
could be a little bit more systemic than that. I mean, it couldn't simply be that capitalism has gotten out of hand in China. And the communist,
just this week, yeah.
and the Communist Party now is cracking down. Now, they've had too much of it at these extremes when, when Jack Ma starts doing his Michael Jackson dances,
Right.
and billions of dollars and all that sort of stuff. But they just, it's just gone. Having been in China, you get a little bit of that sense. When people like it a little too much, it's capitalism.
Right.
And then maybe it's time for government to reassert it. It could be something else.
So
You couple that with more US government assertion.
Same thing. Yeah. No way.
And that's the other, one other thing that's been talked about somewhat, in China being a closed economy or a closed government, they can just decide one day to take some action. If they want, here in the US, if they view Facebook or Amazon as becoming too big a monopoly, it's not just overnight that an action comes out that strips the company into pieces or does something to curtail it. It's a process that takes a while. It takes public hearings. It takes all of these things. So you kind of see it coming.
Yeah.
In China, somebody just hits a button one day and there's the rule. And so there's a difference in terms of how you get there, even though that type of thing happens here too. It has happened in the past. Maybe it happens again in the future with, again, some of these larger, bigger companies, but you see it coming. You see it, and the market has a chance to kind of work through that for a while before it actually happens.
And it might be helpful to remember that the Chinese are run by a communist party. And part of what you're looking at is maybe the experience of wealth they've gotten experience.
My question is like, a lot of their capital growth has come from outside money from different countries. Now, if they go internal, do they have enough population support?
They got a bunch of empty buildings, I tell you.
Certainly they have the population. The question is,
They don't have the money, what are they gonna buy?
and there's a transition, because if you think about the amount of productivity or the amount of economic activity that's done in that country is for other places. And so there has to be a just that you think about the trillions of dollars that's going either to US, to Australia, to all these other places. And if that dynamic changes, you have to kind of internalize some of that, more of that consumption, which they're naturally doing anyway. But I'm just saying, if something is interjected into that system that requires that transition to happen more quickly, that will be disruptive, at least in the short run. So again, I'll jump into the report. I'm going to be fairly brief today. I mean, I really can't say this to either. This looks just fantastic. I mean, the markets have really continued in wonderful fashion. So if you start on page 2, what you'll notice is your equities are more of an overweight than they were before because they continue to perform well. You'll notice the largest overweight is in larger cap versus the non-large cap. And again, it's more of a function of relative performance recently, but things really are just performing beautifully. If you flip over to page number 4, top line, fiscal year to date, again, this is through August 31, 29.59%. Just a remarkable rate of return. Now, certainly here in the month of September, it has become a little bit more rocky. Certainly, if you just take a step back for a second and say, okay, over the last 11, 12 months, our equities are up 40, depending on the benchmark, 50, 60%. It has been a wonderful run. Certainly, prices are higher than they were a year ago. And so the market kind of taking a breather wouldn't really come as a shock to anybody. When you combine that with the fact that it's September, which is historically the worst month of the year, and you have, a $3.5 trillion stimulus package being argued about, you've got potential corporate tax increases and we could talk about the likelihood of any of these things happening or not. But I just think if you look at the volatility in the market, kind of given where we've been the last 12 months and all of these potential unknowns hanging out there, that this kind of volatility is not all that unexpected. So, again, I certainly don't think we're going to get another 40 or 50% out of the next 12 months. My guessing is going to be fairly choppy, but fundamentals still seem reasonable. The Fed tapering, that's the other thing I neglected to mention. That's going to be likely happening here fairly soon. But the market, at least so far, is handling all of those news updates fairly well. I think with it 2011, I think the Fed learned how not to do it and shocked everybody and just all of a sudden one day decide, hey, I'm going to announce this tapering. So they're really stepping into it, and the market, at least so far, has acted favorably. But again, prices are elevated, and so expect some volatility in choppy markets. Again, I'm just going to touch on really quick on page 5, Twin. That's a manager we've been talking about. You've seen some kind of nice continued relative performance out of them. Over the last 6 months, they're 100 basis points ahead. Now they're never going to outperform by 6-7% because of their enhanced index type approach. But certainly nice to see that kind of turning around. Had kind of some consistent few months here of relative performance. And then a little bit of a give back. Some of your managers that had done very well for the previous 6 or 9 months, like Barrow Hanley and Pazina, giving back. Pazina did well in the month, but you can see a little bit over the last 6 and 9 months, just a little bit of underperformance. But again, when you look at either the fiscal year to date or 1 year column, you're looking at very, very strong numbers. I'll just touch on a few. Barrow Hanley at 45% for the 11-month fiscal year, Pazina at 72%, and DGI at 46%. Even though DGI in the last couple of months, you see some red numbers underperformance, but over the fiscal year, they're almost 10% or 9.5% ahead. So again, overall, still very, very strong.
And that's the rotation. Growth to growth.
I'm sorry?
Is that the rotation out of growth to value that's been talked about?
I mean, that plays a part of it. But even DGI, just the way they manage money, they're not in just the broad growth category. So if growth does well, they do well, because generally growth has been doing better the last couple of months, and you can see they haven't participated. But again, it's really just the nature. They're relatively narrow focused in terms of valuation. You will have months and quarters where the market just does not care about those things, and they look silly. But then all of a sudden you'll have another few months or quarters where those characteristics are valued and they're up huge. And that's really their pattern. We've seen that over many, many years. So again, no issue with the portfolio. It's just over short periods, the market kind of ignores what's happening. Mm-hmm. And then of course the Silchester and Bailey Gifford you just heard from, again, long-term have been fantastic. It's not a surprise, but Bailey Gifford's portfolio has suffered in the last few months in big part due to the China news, but you can see at least in this month that it recovered nicely. So again, we don't have any long-term concerns with that. It's certainly just an issue that they're going to have to continue to work through, and as Kevin kind of referenced, kind of reassess the landscape and make ongoing decisions. But we don't see that as a
interesting contrast between the two. One seems much more quantitative than the other. These fellows really seem a whole lot more subjective, a little bit more ESG oriented.
But how much of that is just process? And I think part of it maybe is value and growth.
Yeah.
That obviously on the value side, you have a lot more really numbers that you're focused on, where on the growth side, I mean, yes, you want them to obviously have good fundamentals and the good numbers, but what you're really projecting is future improvement, and you don't have, kind of those numbers to go on. But again, overall, the markets have done well. The plan has done very, very, very well. And I know
The chairman.
yeah, absolutely, they get all the credit.
Is there any managers on here that do concern you?
In terms of process and philosophy, no. The Brown underperformance is something that we've talked about. I think that's going to continue to sort of be an issue if we don't see improvement there. That's kind of the one most glaring one, along with Twin. You know, Twin is made now kind of 6 months of steps in the right direction. I think a big part of that is sort of, again, around the growth value split from last year. But we need to see that continue because, again, even though you're not paying a management fee, being well behind the index, you know, you could just have an index fund, pay 4 basis points and get the index. So if we continue to see that move in the right direction, but those are kind of the two at the sort of the top of the list in terms of, you know, most.
See other managers that are comparable to Brown in that Russell 1000 growth category across to other clients of yours that are performing well, are beating the benchmark, or do you see it
Not over the last
across
couple
the
of
category?
across the category over the last, in particular, 2 years, no. Most managers, and again, this is something we kind of talked about at the last meeting when Brown was here. You know, in 2015, the top few stocks represented 10% of the index. Now it's over 30. And if you've got a concentrated strategy, I mean, the only way you've been able to outperform is if you had 12 or 13 or 14% in Amazon or Facebook. And from a risk control standpoint, who's going to do that? You know, if we were looking to hire an active manager and somebody came in and said, yeah, we have a portfolio with 50 stocks, but our biggest holding is Amazon and we get it at 14%, you'd probably say, no, thank you. That's more risk than we want to take. But that's, you know, over the last couple of years, that's kind of what was needed to outperform. You had to be overweight that very select few names. And quite frankly, very few managers would do that. So again, when you do a 2-year look in particular, you see managers that are 2, 3, 4, 5% behind annualized over that period. And it's primarily due to that concentration.
Okay, thank you.
If there aren't any other questions in the book, then the only other thing I'll just kind of touch on briefly, you guys, maybe with the exception of Pat, have all seen this before, but just sort of an update that quite frankly isn't much of an update because of the continued run in the market. So this is what we call the drawdown chart. And if you look on the far right-hand side, what you'll notice in the last 6 months, there haven't been any drawdowns. So there isn't any writing in either the red or the green or that kind of yellowy or peach shaded colors because we haven't had a single drawdown of more than 5% over these past number of months. And actually internally, just for your own reference, they've kind of said, okay, we got tired of updating this chart every time to show nothing because there weren't any drawdowns. So they've kind of said, we're only going to update it in months where there's a 5% drawdown or a subsequent recovery. But again, what you can see, this just kind of gives you some scale going back to the great financial crisis back on the far left-hand side in 2007. And then it gives you context of any decline of 5% or more. And it tells you how many trading days that decline took to realize. And then in green is the number of trading days, or in this case, years that it took to recover that loss. And sort of the short version of this chart is all along the way, you see 18%, 12%, 7%. It's very, very normal to have these pullbacks that we're seeing here in September. But, we stay the course as a long-term investor and you get rewarded for that. You heard a very similar message from Bailey Gifford and Silchester, as part of their process. But this just kind of puts a little bit of context to kind of where we've been. And again, from the lows back in early last year, if you think about that, in the last 1.3 years, we're up 102%. Or from the bottom. So again, just a little bit of context, but I suspect when we get to the end of September, I'm pretty sure the drawdown mid-month was over 5%. So we'll have one of these little shaded regions and hopefully by the end of the month, it'll be fully recovered. But that's, again, just sort of a normal part of the process. But we like to, again, show you this as just sort of context for where markets have been and hopefully where they're headed in the future, despite some of the speed bumps we feel along the way. Thank you.
All right. Next, I don't see any old business, there's a piece of informational items that I reviewed. William, anything particularly you want to emphasize?
I just wanted to point out, we updated the chart on the pension obligation bond proceeds returns because we had numbers through August. And then also Matt had pointed out, we are actually using the incorrect number at the beginning. The total was, I believe, it was over 56 million that was invested. And so I think the initial tranche, we had started out with 42 million because we adjusted that for cash that we already had in the account, but we sort of over adjusted for the cash. So instead of 42.67, we only had 40 million listed there. So anyway, we updated that. There was also a little bit of a difference in the way we did the calculation for the return if we'd invested everything on November 5th. We had been using some manager partial month returns there. So we corrected for that and just updated that number as well. That was something the city manager had requested that we provide. So anyway, that's an updated chart there. We're probably gonna, the city manager's requested we continue to monitor this, and provide this information to the city commission. And so we're going to continue to do this going forward, but, we'll just bring it to the committee. We don't need to talk about it every time, but we'll bring it to you maybe quarterly or something like that. And then the final item on the agenda was an affidavit of extraordinary circumstances. So there's a new city policy that for all city commission boards and committees that they're allowing virtual attendance, participation in board and committee meetings, but that's predicated on extraordinary circumstances. And so going forward, they'll want PRC committee members to fill this form out if they want to participate virtually. And if they want to actually vote, then we would need to have the form signed and notarized prior to the meeting.
So are you saying, again, we have one member who's very, very capable, but does travel a long way remotely. And I frankly, I want as much intellectual firepower and professional skill and experience on this committee as possible. So are you saying that if that form is not completed, that someone can participate, but they just can't vote if we have a quorum of physical? And I'm trying to understand.
So they need to fill out the form if they're going to attend the meeting virtually.
Okay.
And sign it. If they want to vote, they need to have it notarized as well. So they've got to fill out the form and sign it regardless if they want to even Zoom into the meeting, say. But if they want to vote, then they will need to have it notarized. And we've got notaries here. I believe the Police and Fire Pension Board attorney yesterday mentioned that you can also, there's online notaries that you can use now where you show your driver's license or whatever. And so that you can do it that way as well if you can't, mail it to us or whatever.
Scan it and email it to the clerk?
Yes, or to me.
Or we do like we suggested yesterday, just do one,
I'm sorry.
have one on file.
So that issue came up yesterday, and it's really not intended to create an ongoing affidavit. This is a circumstance because it is by definition an extraordinary circumstance.
Yeah.
So
So I read.
it's hard to say that you fill one out for all future absences. And they want it done on a meeting by meeting basis.
Well, in all due respect, I do understand the overall intent. You want people participating in boards, so you have a quorum and so forth. I mean, do we want bodies or do you want intellectual capital participating in a meeting? And so It's my personal opinion. I think this is,
Well, then, I
This
mean,
is
realize
totally-
this isn't coming from the finance department.
and I understand that, no, I understand that, and I know it's a state rule, and again, I understand the politics behind some of this, but it certainly serves as an encumbrance to my view of having participation of the most skilled people that we can have on the board. So if it's our goal to have physical bodies around a table, this will work. If it reduces the ability to have skilled people participate in these committees, I think it's very counterproductive. I understand that's the rule, but that's my opinion, and my opinion won't change at this
Well,
point.
staff will do whatever we can to
I realize
assist,
that.
so if, you do expect to be absent, if you let us know, we can help you with the form. And, if you want to, as long as we have a quorum, if you're not concerned about voting on issues, and a lot of meetings, we don't have any votes, except maybe the minutes. So if you're not that concerned about voting in a particular meeting, then you don't need to worry about having it notarized. You can just fill it out and submit it to us.
Okay.
So, there's that consideration, and this policy may change going forward. Everything is still sort of up in the air, so if there are any updates, we'll let you know.
Well, yeah. In a digital world, there seems to be this type of policy is a little bit behind the times. But again, I understand the intent. We want to follow the rules and so forth. Everybody knows that if you can't make the meeting, we need to fill out this form, and we'll allow you to participate. And I welcome participation. So, but then I know I appreciate you had to be the bearer of bad news. So I appreciate the discussion, and everybody knows my opinion on it, so that's okay too. All right, well, thank you. Is there any other, any public comments that we have? Anyone joining the meeting remotely that we need to invite?
We
to
don't,
give a form?
no, we don't have any public remote
The
participation.
public, okay, all right. Don, as always, thank you for participating and listening. It's always great to have you here.
For having me. I've enjoyed it over the years of being a part of this board, as a citizen, and financial money to invest, to take and be financially invested in the board. Maybe in the future I will.
Okay.
I'm running for mayor for the city of Gainesville, and I'm hoping and praying to the Lord Jesus as far as the people's interest that I do get in, because my outlook for our city and my outlook are doing investments that Gainesville needs has been looked at by others. I feel of the commissioners and mayors. I think this is a shame of our city to take and neglect this infrastructure money coming in, to push out corporate investments like your railroad or your trucking company or your places like FedEx and UPS, has been a default of our city. And I want to bring that to our city and make it part of our infrastructure money so that we can capitalize.
Appreciate your comments, Don.
That's my comments, sir.
Great, thank you very much.
No, I have one other.
What's that?
I've been told by rumors that our employee pension is in default.
No, that's not, yeah, that's a rumor. That's not true, Don.
So I
So,
wanted to bring that up.
and I appreciate, yeah.
True ain't.
There's lots of rumors about lots of things these days, but I'm very happy to report we are absolutely not involved in anyone that's stating
Coming
that's
from Nathan
incorrect.
Scott.
Yeah, well, I said, I don't know the source, I've not heard the rumor, but
Okay.
I can assure you, we are not involved. Thank you for the concern. Great, if there's no other discussion points, I'd be happy to entertain a motion to,
So moved.
we have a motion to close the meeting. Do we have a second? The meeting is adjourned. Gentlemen, thank you everyone for your participation.